Hello and welcome to another video on how to secure yourself financially. So right now I'm going to jump straight forward to this uh, section, which is the financial statement ratios and calculation, and make a quick overview of what I have learned so far from this section. So the sec.gov uh, described here is a beginner guide to financial statement and well what are financial statements after all? They show you the money, and there are four types of them. Balance sheet that shows what a company owns and what it owes at a fixed point in time. The TLDR of this balance sheet is a snapshot of the company assets, liabilities, and shareholders' equity over a period of time. The income statement, which is another financial statement that show how much money a company spend and make over a period of time. So the bottom line of that statement shows you that. And you can think of that as a set of stairs that you start at the top with the total amount of revenue, and once you go down each step down the stair, you make a deduction associated with that earning or that revenue. So broadly speaking, you have things like merchandise returns and discounts, and then you reach to the net revenue. So once you go one step down, you deduct things like the cost of sales to reach to the gross profit, as well as other expenses. But again, this is just broadly speaking of the entire process. So once you reach at the gross profit step, once you go down, you make a deduction now with things like amortization and depreciation, as well as stock-based compensation, also the operating expense. Uh, in this case, is how much money a company. So what is the operating cost for that business to run its day-to-day activities? For example, administrative salaries, uh, marketing, the cost of research and development. So once you go down the stair, then you reach, after you deduct that, you now are on the operating expense before interest, which is the amount of money that you can earn from lending money, or the interest that you have to pay for loans that you took. So, for example, money market fund is one of them, as well as the income taxes, money that you owe to the government. Once you deduct that, then you reach to the net income. The next financial statement is, well, the cash flow statement. That show is the exchange of money between the company and the outside world. And also, lastly, is the statement of the shareholder, which show is the change in interest of the shareholders over a period of time. And this is something that doesn't focus in this section. It only focuses on the first three. So the cash flow, it show is the net increase or decrease in cash over a period of time, which is the bottom line of this statement, and it reviews information from the balance sheet as well as the net income from the income statement. And this statement review the cash flow from one of these activities. Review the cash flow from these activities: operating, investing, and financing. So you can think of this like when someone is looking at a beach, okay, uh, for boats, but that is looking at from different perspective, okay. So let's say you are in a dock and you want to see or you are in an airport. Okay, if you want to see where, when the airplane come from. So by putting yourself in different positions of the airplane, you can see is different perspective of the airplane. And meaning you can see is different angles of not only the airport but also about the plane. So that's an example of that how this financial statement, the cash flow, review the cash flow from this activity, the operating activities, investing in financing. So operating activities, what it does is to conciliate is so it analyzes the net income and conciliate with the total amount of cash that was used or perceived from operating activities. It can be broken down into operating assets and liabilities, where operating assets are things like inventory, property, plant, and equipment, prepay expense such as premium insurance, home, health, vehicle, liabilities, disabilities, long-term care such as nurse healthcare or home healthcare, marketing, rent, software license, and maintenance contracts are another example of prepay expense. Okay. Also, you have intangible assets such as patents, trademark, copyrights, goodwill, customer relationship, trade secrets, as well as investment in affiliates such as joint ventures, equity investment, associate, limited partnerships, as well as cash and cash equivalents such as money market funds, for example, which these are funds that involve in the purchase of large volume of very short-term debt financial instrument such as bank of deposit or certificate of deposit, bank acceptance, commercial papers, repurchase agreements or repo, or treasury bills. And when it comes to the liabilities, right, such as, or the most common operating liabilities, we have things like accounts payable. Another common operating asset are accounts receivable. Okay, so on the operating liabilities, we have accounts payable, money that you own to your vendors and suppliers. Account. Accounts. Jesus, how do you put it? Accounts payable, right? Accounts payable, accrue expense. So money that a company or expense that a company incur on good and service that has been received, but it will pay in the long run. So, for example, for good accrue expense are good or service that has been received but not yet paid for. So, for such as rent, administering salaries, as well as taxes, utility bills. Also, I look at the deferred revenue, which are obligations that a company has to pay for good and service that will be delivered on the future based on money that has been collected. For example, gift cards, subscription service, as well as the short-term borrowings, notes payables, income taxes, whether it's corporate taxes, withholding, or sale taxes, such as VAT, local, state, federal, foreign, excise tax, GST, also warranty obligations. So all of this common operating assets and liabilities is something that the first part of the cash flow statement, the operating activities review that, okay? And it can see and analyze the net income from the income statement with the total amount of cash that was used or perceived by this activity, and also from non-cash items, items that affect the income statement without any cash transaction involved. So for example, depreciation, amortization, as well as the how do you put it? As well as the stock-based compensation. The second part is the investing activities, where this generally involved is the purchase of long-term assets such as property, plant, and equipment, intangible assets, investments, leasehold improvements. In the last section, which is the financing activities, where this section review is how a company raises funds from investors and pays back directly through capital markets. This section helps investors to see how often a company is raising funds and where the source of money is coming from. So this activity involved is the asking loans from investors or creditors, repay them, and share dividends or distribute dividends. So broadly speaking, we have a couple examples here, such as issuing equity, issuing debt, repaying debt, repurchasing stocks, as well as leasing. Okay. So with that, then I look at the footnote, which is something important because it describes things like accounting policy and practice. So how these companies are adhering to this accounting practice, and which is some information that most disclose that is sensitive. So for example, they have adhering to GAAP, which is generally accepted accounts principle. This is something that was created after the 1929 crash, and or recently is now you have this international reporting financial statement, which the whole idea is that because company now is becoming more and more broad, and these multinational companies, and now the accountants around the world need to find and set some guidance and standards that help them to make financial statements consistent, transparent, and easily shareable around the world. So another topic that this footnote describes is the income taxes. It describes this in a more fine-grained detail. So for local, state, federal, foreign. Also, it discusses about the pension and any other post-retirement programs, the cost of these programs, and how well are funded. over or underfunded. And then the stock option, which is some kind of compensation that the employer offer to employees as a form of all the hard work that they're gonna put right now will be reward in the future, right? Okay. So these stock options are financial instruments, and when we talk about financial instruments, according to Investopedia, this is an asset or it also can be seen as a package of capital that can be traded. So stock options is a financial instrument that allow the owner the right, but not the obligation, to sell that asset at a given upon price and date. And then you have two type of options. You have put, bet that the stock will fall, or calls, bet that the stock will rise. And this is a type of equity derivatives, meaning that the value of the stocks is based on an underlying asset or a group of assets with a benchmark. So with that, okay, it also is important to recap about the MD&A, because this management discussion and analysis of financial conditions and results of operation, which is a long name to simply describe, is from the management perspective, they're going to give you insights about the company trends, the risk that has shaped this company in the past, and most likely will do that in the future, and an opportunity to describe from the management about the financial conditions and operations. So things like taxes, things like how this company is being affected by the macroeconomics, politics, uh, as well as risks that have shaped the company past. When it comes to how they have handled is this task, or all the operations of their business. So this is a very interesting topic, something that I go over with Apple and Amazon, and also you can see, for example, is in more detail which jurisdiction they have physical address or legal address, fiscal address, uh, and also the challenge they are facing as company, as well as the market they wants to get into. So yeah, that's actually something very, very interesting to look at it. So there's something called the 10Q, which show is this MD, which is the quarterly report that shows you that. Something awesome to look at it. It's very, very interesting because you can see now, okay, you can gain more and more perspective about why are you working, and what is the reason of doing that, and what will be the important trends that can shape not only this industry or this company, but also the overall perspective in the long run, right? The long-term vision here. So, okay. And now, what we really care about here is the financial statement ratios and calculations. So these are set of metrics, okay, or as they mentioned here. So listed below, just some of the many ratios that investor calculate from information on financial statement and then used to evaluate a company. Again, these financial statement ratios and calculations are a way to evaluate a company. As a general rule, the startable ratio vary by industry. So financial statements, ratios, and calculations. Okay. So if a company have a debt to equity ratio two to one, okay, it means that the company has $2 of debt for every $1 shareholders invest in the company. Or in other words, the company is taking on debt at twice at the rate its owners are investing. Is this good or bad? Depend of the industry. So, for example, research and development, this kind of debt to equity ratio most of the time will be like this. Again, I need to make a research for that, but the whole point of this is to understand that this ratio, the debt to equity ratio, depend on the industry. You have some desirable ratios. So yeah, so debt to equity ratio 2 of 1, an example, it indicates that the company is taking uh, on debt twice the rate of its owners are investing in the company. So again, depend on the industry, this might be good or not. The other is inventory turnover ratio. Cost of sales slash average inventory for the period. Cost of sales slash the average inventory of for the period. So the cost of sales is the total amount of money that the company spent on producing that good or service, whereas the average inventory for the period, okay, where yeah, average inventory for the period, average inventory for the period. If a company has an inventory turnover ratio of 2 to 1, meaning that it has more cost of sales than the average inventory, it means like the company's inventory turns over twice in the reporting period. So the cost of sales, inventory turnover ratio. Okay. So inventory turnover ratio is to indicate, compares a company cost of sales on its income statement with its average inventory balance for the period. To calculate an average inventory balance for the period, look at the inventory number list on the balance sheets. Take the balance list for the period of the report and add it to the balance list for the previous compatible period, and then divide by 2. Remember that the balance sheets are snapshot in time, so the inventory balance for the previous period is the beginning balance for the current period. And the inventory balance of the current period is the ending balance. The calculated inventory turnover rate is you divide a company cost of sales just below the net revenue exactly on the income statement by the average inventory for the period or operating margin. But if a company has a turnover ratio of 2 to 1, it means that the company inventory, what it possesses, turn over twice in the reporting period. So you have more inventory turn over twice. So you have more inventory. You have more inventory. What the hell? 2 to 1. Operating margin is equal to income from operations divided by the net revenue. This makes a lot of sense. If you want to know, is from this income, the income from operation, you want to, so from the net revenue, okay, the total amount of revenue, you want to know which one of them actually is, it comes from the operations. Operation is usually expressed as a percentage. It shows for each dollar of sales, okay, it shows that for each dollar of sale, what percentage was profit. Okay, what percentage was profit. And then you got is PA ratios, price per share and earning per share. If a company stock selling at $20 per share and the company is earning $2 per share, then the company PA ratio, price per earning and earning per price per share and earning per share ratio is 10:1. The company stock is selling at 10 times it is earning. Okay, so with that, that'll be all for this video. Okay, and take care.